3 weeks ago, a wallet dormant since 2017 quietly moved 1.2 billion XRP across 4 addresses. Not a single mainstream crypto outlet covered it. No CoinDesk breakdown, no Bloomberg alert, just silence. That same week, Ripple's OTC desk recorded one of its highest volume settlement weeks of the year, while a particular European custodian registered 3 new institutional XRP custody clients without a single press release. You're watching a significant repositioning unfold in real time, and almost nobody is talking about it because the price chart is screaming the opposite story. That gap between what the candles show you and what the on-chain data is whispering is the entire thesis of this video. By the end, you'll understand why people calling XRP dead money right now are about to become the exit liquidity that funds the next leg. We're going beneath the surface of a market deliberately designed to confuse you. No hype, no moon math. Just what the data, the filings, and the silent actors are actually telling us about XRP heading into the back half of this cycle. Start with the hard truth. Roughly 90% of retail traders are staring at the wrong chart, watching the wrong indicators, reading the wrong headlines. They see XRP bleeding alongside the rest of the market. They see Bitcoin dominance staying elevated. They see the S&P 500 ripping to fresh all-time highs while their crypto portfolio sits in the red. And they conclude that crypto is dead, that XRP missed its moment, that the rotation never came. That conclusion is precisely what institutional desks need retail to reach for the next phase to execute properly. The crypto market is not behaving the way it did in 2017 or 2021. We're no longer in a cycle dominated by retail speculation, flowing in waves from Bitcoin down to large caps, mid caps, and memes. That model is gone. What's replaced it is a 2-track market. On one track, retail capital chases whatever has the strongest visible momentum, concentrated right now in AI stocks, semiconductor names, and a handful of mega-cap tech plays inside the S&P. On the second track, completely invisible to most people, institutional accumulation is happening through over-the-counter desks, custodial cold storage transfers, and structured product hedging. Those 2 tracks don't move together. They often move in opposite directions, and that's exactly what we're seeing right now. On-chain data from Glassnode and CryptoQuant shows XRP exchange reserves declining for months. Tokens are leaving exchanges, and they're not being sold into the order book. They're moving into custody wallets tied to regulated entities. That's the signature of someone planning to hold for years, not weeks. Cross-reference that with Ripple's escrow release behavior, where they continue releasing 1 billion XRP monthly and immediately relocking the vast majority back into escrow. And what you're looking at is deliberate supply management that is tightening, not loosening. So why is the stock market a distraction here rather than a leading indicator? The S&P hitting consecutive all-time highs isn't a sign of broad economic health. It's concentrated capital flowing into a narrow set of names because those names have the simplest narrative for institutional algorithms: AI infrastructure, power generation, chip manufacturing. Crypto, by contrast, has spent the last 2 years being rebuilt at the regulatory and infrastructural level. The plumbing is being replaced while the building still appears to be standing in the same place. That work is mostly invisible, but it's precisely what determines where capital flows next. Think about this logically. If you're managing a multi-billion-dollar fund and your mandate now permits exposure to digital assets through compliant rails, you don't announce that on Twitter. You don't telegraph your accumulation. You build positions slowly through OTC desks, at prices retail considers depressed. You wait for the regulatory framework to finalize, for custodial infrastructure to harden, and for the macro liquidity environment to shift in your favor. And while you wait, you're perfectly happy to see the asset trade sideways or down, because every day of suppressed price action is another day of accumulation at a favorable cost basis. This isn't a conspiracy theory. It's how every major repricing in financial history has been set up, from gold in the late 1990s to Bitcoin in 2020. Here's the math retail keeps ignoring. XRP has a fixed maximum supply of 100 billion tokens. Of that, roughly 55 to 57 billion are in circulation. A meaningful chunk of that circulating supply is now sitting in long-term institutional custody on platforms that don't see active trading flow. Analysts who track on-chain token movement suggest the liquid float available for active exchange trading may be as low as 15 to 20 billion tokens. Now consider the markets XRP is designed to interact with. Cross-border payments globally clear roughly $150 trillion annually. The foreign exchange market processes around $7.5 trillion per day. The tokenization wave being built across major financial institutions is projected to address multi-trillion-dollar markets over the next several years. If XRP captures even a fraction of 1% of those flows as a settlement layer, the demand pressure against a 15 to 20 billion token liquid float produces a price reaction that isn't a prediction. It's arithmetic. Either the price moves up to accommodate the volume, or the system can't function. Ripple isn't building infrastructure that doesn't function. Look at what Ripple has acquired in the past 18 months. Hidden Road, a prime brokerage with massive institutional reach, and G Treasury, which gives Ripple deep penetration into corporate treasury operations at the enterprise level. You don't make those acquisitions if you're positioning for retail speculation. You make them if you're building the rails for institutional settlement flow that will run through your network for the next decade. The capital involved and the regulatory due diligence required to close those deals tells you where this is going. Then there's the spot ETF environment. Issuers that previously wouldn't touch XRP due to regulatory ambiguity are now actively filing and competing for the product. ETF flows don't behave like retail flows when they arrive in earnest. They're persistent, programmatic, and largely insensitive to short-term price action. They buy at whatever price the market offers because their mandate requires them to track the underlying asset. Once those products gain assets under management at scale, they become a structural buyer that doesn't sell on red days. That's a fundamental shift in the supply-demand equation the market hasn't priced in yet. If you're still watching, you're in a different category than the average viewer. Drop "positioned" in the comments. I want to see how many of you are paying attention to structure rather than noise. And if this kind of breakdown is what you came here for, subscribe. Because what comes next in this market will require a very different kind of analysis than what most channels are offering. Now the macro layer. The Federal Reserve is in a transitional posture. After an extended period of restrictive policy, conditions for liquidity expansion are increasingly aligned. Inflation has moderated relative to peak levels. Labor market data is softening enough to give the Fed cover for accommodation. Global central banks, particularly in Japan and the Eurozone, are managing balance sheet challenges that effectively require coordinated liquidity responses. When that liquidity returns to the system, it doesn't stay in cash. It flows into assets, and the assets that benefit most are those that are scarce, productive, and positioned at the front of structural narratives. XRP, with its utility positioning and compressed price relative to its addressable market, sits in exactly that category. The catalyst timeline from here is also denser than most people realize. Ongoing regulatory developments in the United States, with frameworks like the Digital Asset Clarity Act continuing to mature legislatively. The Japanese FSA continuing to evolve its stance on digital asset settlement. The IMF holding internal discussions about the future of cross-border settlement infrastructure, with their working papers increasingly referencing distributed ledger technology. Central bank digital currency pilots testing interoperability with public blockchain infrastructure, where Ripple has been a quiet but consistent technical partner in several of them. Any one of these maturing into a public market-moving event would be sufficient to trigger significant repricing. Multiple converging on a similar time frame is what makes this setup different from anything we've seen before. We're moving from an era of XRP abundance to one of scarcity. That transition isn't gradual, it's nonlinear. The moment institutional buyers start sourcing meaningful position sizes through exchange order books rather than OTC desks, the available float gets consumed at a velocity retail won't be able to compete with. There won't be a polite warning or a gentle slope upward, just a gap. And once that gap occurs, the entry prices that exist today won't exist again in this cycle, and quite possibly not in any future cycle. I know this is where conviction gets tested, because watching the chart right now is genuinely painful for anyone who's been positioned for a while. Red candles, sideways action, the slow grind of a market that refuses to validate your thesis on your timeline. But here's what you have to internalize. The discomfort you feel right now isn't evidence that you're wrong. It's evidence that the accumulation phase is still functioning correctly. If the price were already running, institutional accumulation would be over, and you'd be the one buying into green candles at an unfavorable cost basis. The fact that it's boring and frustrating is proof the setup is still intact. Being early feels exactly like being wrong, right up until the moment reality catches up. The investors who built generational positions in transformational assets didn't do so by feeling comfortable the entire time. They did so by recognizing that the periods of maximum discomfort are usually the periods of maximum opportunity, and they had the framework to distinguish noise from signal during those periods. That's what this channel is built around. Not telling you what you want to hear, but giving you the framework to see what's actually happening beneath the surface. The question worth sitting with after this video ends is a straightforward one. When the rotation from equities back into crypto begins, and it will begin, because no concentration of capital in a narrow sector has ever sustained itself indefinitely, who will be holding XRP at that moment? The traders who panicked at every red candle and rotated into whatever was working that week? Or the small minority who understood that the silence was the signal, the accumulation was the story, and the price was the distraction? That answer determines who participates in the next phase and who watches it from the sidelines. The infrastructure is being built whether the market acknowledges it or not. The regulatory clarity is forming whether the headlines cover it or not. None of this requires your participation to proceed. It's happening on its own timeline, driven by actors whose capital and conviction operate at scales most people can't imagine. Your only decision is whether you position yourself in front of that wave or behind it. The chart is a distraction. The structure is what matters. The people who built that structure didn't do so to enrich the impatient. They did it to reward those who paid attention when the room was quiet. Stay patient. Stay rational. In a market fueled by emotion and noise, data and composure are your edge. The numbers don't lie, the architecture is nearly finished, and the silent repositioning happening right now will look obvious in hindsight to everyone who missed it. Make sure you're not one of them.